Hello everyone, welcome to today's backtest. And our backtest will be on January 27th, 2026 on gold. So gold continues going like outer space, non-stop. Okay, so I thought I never expected this move, to be sincere. This move on the 27th of January. Like it was really massive. And gold keeps breaking all-time highs over and over and over and over and over again. You see, when the market breaks all-time highs, it's really interesting to watch, okay, to study and all. And not to talk of market who does this. Like gold has broken all-time highs over and over again throughout this month. And like I said on my previous video, I'll be going slow because this is the last week of the month of January. So I won't want to involve in trading fully. So let's get to it. Let's get to gold with 15-minute time frame. Okay, first the 4 hour time frame. So this is a volume imbalance. Okay, so volume imbalance is the gap between the body of two different candles. Okay, so you can see the wicks overlapping, entering into the gap, but the wicks are not considered. This is the body of the candle, and this is the wick. Okay, so the gap, the volume imbalance by definition, is the gap between the body of two different candles. Okay, so this is the this is the close of this candle, this and this is the open of this candle. Okay, so the gap between the bodies, that's your volume imbalance, and this is a 4 hour time frame, so which makes this what a 4 hour volume imbalance. And you can see price trading into it. Okay, the volume imbalance is also a type of inefficiency in price. Okay, so price comes in, trades into the inefficiency to rally up. Now let's go to the 15-minute time frame. So you can see the 4 hour volume imbalance at the 15-minute time frame. You can see this price movements, okay, which run up in price. So the fair value got created. Let me bring this out. This is the fair value gap. So these three candles forms the fair value gap. Candle 7:45, 8 p.m. and 8:15. So the high of this candle at 7:45 and the low of this candle at 8:15. That's what's that's what's forming your fair value gap. Okay. So this is the 15-minute fair value gap. There'll be no need to label it 15-minute fair value gap, just fair value gap. That will be okay. Okay. This is your fair value gap at a 15-minute time frame. Now our focus is on the New York AM session. Okay, not just the New York AM session, but the New York PM session as well. So at the New York AM session after 8:30, is 8:30. After 8:30, there was a drop down in price into this bigger fair value gap. Okay, there was a drop down in price into this bigger fair value gap. Also taking out what relative equal lows. See this low, taking out lows in price. The price took out this low. It also took out these lows as well. This and this. Okay, so we'll be focused more on this because this was the one which is lower and also drop down into the fair value gap at first. So this sell side liquidity. Bottom left, if the price drops down into it during the New York AM session, and this is our Tuesday first presented fair value gap. Okay, I talked about the first presented fair value gap. Is the first gap that is the first fair value gap that is being created after the market open. The market open is at 9:30, after 9:30. Okay, the market open. So the market opens at 9:30. 9:30 a.m. New York session. Also, your time zone should be set at New York to get this right. If not, you'll be doing everything wrong. Okay, so look at my time zone. Mine is set at New York. So going to the 1 minute time frame, and I normally draw mine from the 1 minute time frame, my first presented fair value gap. So the first gap that is formed with displacement after 9:30, that's the one I pick, not just the first gap formed. Okay, because there are some gaps that are really very small, like this one. Okay, so this is 9:30. This broken line right here, this is 9:30. And if you zoom in, you notice a very small gap right here. Okay, so this is very small, and using that kind of gap for my first presented fair value gap won't make any sense. See, I can't even see it clearly. Okay, so that's not the type of gap you want to use as your first presented fair value gap. You want to look for the first one that actually forms with displacement. So this was the one formed with displacement, and also taking out a lie, an I. Sorry. Also taking out an I while it was forming is also a plus. Okay, so you can see how I drew my first presented fair value gap. And also I get there was volume imbalance beneath it, so I had to give room for the volume imbalance. Also a volume imbalance above it. Okay, so this also called the suspension block. So that's not a focus. For those who follow up with ICT's mentorship videos, which are free by the way, you know what a suspension block is and how price makes use of it. So back into the 15-minute time frame. Okay, after price took out these lows, okay, taking out sell side liquidity, sell stocks, price rallied up and traded above these short-term highs right here, this relative equal highs, short-term highs, and formed a small fair value gap. You can see this on the 15-minute time frame. Okay, you can see it's on the 15-minute time frame. On the 30-minute time frame, I think it's bigger on the 30-minute time frame. So on the 30-minute time frame, this gap would be like this. This was the gap on the 30-minute time frame. Okay, but on the 15-minute time frame, this is how it looks. Also, if you take notes, this gap right here on the 15-minute time frame, at the top of the gap there was a suspension block. There was a volume imbalance at the top of the gap. See the gap between the body of two different candles, and at the bottom, that's why you also have to zoom in to check if there's a volume imbalance. Okay, while trying to draw your fair value gap imbalance or whatever, there's also a volume imbalance at the bottom. So while drawing my fair value gap, I have to give room for the volume imbalance as well. So it will look like this. Okay, I have to give room for the volume imbalance as well. So it will look like this. Let me take this to the back so you can see the Tuesday first presented fair value gap. Okay, beautiful. I'll make this thicker. Now back to our discussion. Okay, price rallied up, took out this relative equal highs, short term highs, then traded down into the 15 minutes fair value gap, and also into simultaneously also into the Tuesday first presented fair value gap. And you can see how price respects this Tuesday first presented fair value gap so beautifully. Okay, traded, it's staying at the top, at the upper quadrant of it. Okay, not able to go into the lower quadrants, and keeping this lower quadrant open. Now price trades into this fair value gaps at what time? During the New York PM session. So the New York PM session starts at 1 p.m. You can see this is the very candle. This is the lowest candle, okay, at 1 p.m. So price trades into it during the New York PM session, and then you can see this rally up so massive, like, oh my god. So let's be realistic, okay? If you actually went in long right here, and you can see price taking out this high. This was actually this was Monday's high, okay? This was the all-time high, the previous all-time high, which price traded above. Okay, and you can see the rally up in price so massive on gold yesterday. So let's be realistic for a moment. If you actually went in long at this point, okay, only few people would actually have the guts to leave their trade up to, let's say, this point. Okay, let's say you traded just up to this swing guy right here. And also, why making trades like this, whereby price takes out the all-time high, you should take partial on your trade. Okay, you should take partial on your trade, and also trade your stop loss to avoid being stopped out. Okay, after getting a huge profit, just imagine price dropping down back to your stop loss. Like, that will be so frustrating. So always try to take partial from your trade, take parts from it, and also trade your stop loss on, especially on a move like this whereby price is taking out the all-time high. Because there are some events, there are some times whereby, okay, there may be an event, and at this point price might just drop down back to this range and take out your stop loss. Okay, so at that time, if you haven't taken out partial from your trade or trade your stop loss, you'll be stopped out while in unrealized profits. So let's see the risk to reward for this type of trade. Long, okay, let's say you went in long at the top of this 15-minute fair value gap, then the stop loss will be at the low of this candle. Okay, you know, three candles form the fair value gap: one, two, three. Okay, so this candle at the left, the low of it right here. Then let's say you trade up to this swing high. This is about 4.2 weeks to reward. Okay, and let's say you trade your stop loss, took partial trade your stop loss, like 6 weeks to reward, 6.9. This is 7 weeks to reward. Like, this is really massive. Like, so I hope you found this insightful, and if this has brought any value to you, drop a like, subscribe to my channel to see more amazing content such as this, more amazing backtests. I'll be dropping more backtests on gold and on Nasdaq, and maybe on some selected forex pairs as well. So until I see you next time, stay safe and God bless.